What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online, as usual. Today, I'm just actually going to correct one thing that I was just wrong about yesterday. Somebody watching the video pointed it out, and I was just trying to do something using Mogul's calculator that wasn't right. So I want to show you something that you can do with it, and then actually just talk a little bit about how maybe we can use this tool for some of our other fractional investing. And I'll show you what I did for a lofty property using this tool. But so when I was going through the assumptions the other day or yesterday's video, I'm looking at the Johnson. If you're not invested on Mogul or Lofty or any of the sites that I mentioned on this channel, you have links in the description below. Please like and subscribe. Oh, I remembered at the beginning of this time. Yay for me. And there's the Discord channel that is just a generic, fractional real estate investors discussion channel that you can sign up for in the description below as well. It's not a sales funnel. I don't have anything to sell you at the end of it, unless you're trying to buy real estate in San Antonio, Texas. That's my day job, but that's not the goal of any of this. So you can sign up for that, talk about this stuff, and not have to worry that there's some ask at the end of that. But so when I was reviewing this property, and this is part of the Mogul playlist, so if you look at my channel, the playlists will have anything that I've talked about Mogul on there, you should be able to find in here. But one of the things that I questioned was, is this yearly rent, and this is a short-term rental, was this accurate? And then I think I was trying to either change it in here. Actually, what I think I was trying to do is change it down here. Their calculator is very interactive, but you have to be clicking in the right spots, and that's what I wasn't doing. If you actually change the monthly amount to a number that, let's see. So, there was some question in my mind if I actually think, I actually think they said that it had been 190. So, I don't know, let's say 15, it was 15, 750. Oops, got way too much in there now. Yeah, that'll get us close enough. If I want to do that, or whatever that rent number that I wanted this to show for the year one, I just have to manipulate the monthly amount, right? In order to do that, and then I can go back and look at, okay, 6.3 cash on cash, 13.4%. I'm not saying that this is the right number. I had a longer discussion about, whether or not their number was right as far as, what they're projecting. So far, these guys have not given me any reason to second guess their underwriting for stuff. I feel like for the most part, they're doing a really good job. I think that for a lot of these properties, they're seeing a little bit more data than I am. They're also talking to, their manager who's going to manage this property for them in those markets. One of the things that I found a lot of times those managers, I mean, there's a range of them, but the good ones are not trying to oversell it because then they have to actually perform right at the end of the day. And so usually, um, and especially usually I find that the better short-term rental managers are pretty good at predicting what they're going to be able to do, as long as you have the capital to to execute on their plan if they ask you to do certain things. What I'm trying to find is, yeah, it's not in this tab. It is their other tab where they show you the those comps where they got that. So, my correction here is not to tell you that this is the right number, just that you can actually manipulate these numbers. You just have to be trying to change the monthly number. And so you can do that. You can change all sorts of assumptions that they use. And then one thing that's really neat that I had sort of overlooked, I think I might have mentioned this once before, is you can use this tool on any address. So I can paste any address in here. And I did this, so I went back and looked at, I talked about this short-term rental a couple of nights ago on Lofty, and then I was comparing this one to the one that Mogul had, and so I was like, well, what happens if I put it in their calculator? And so, most of this stuff generated by itself. It gave me the info on. I actually had to adjust how many it accommodated, but it pulled that in. The values it did for itself, although it picked a higher price, so I moved it back down to the purchase price that we're paying. I input the debt info, that is the debt that the um, that already exists on the property. And so what I'm trying to do with this, one of the things that I'm always talking about with lofties is there's a lot of financial engineering that goes on to create the returns that you're getting. A big part of it is treating the debt as being outside of the entity. And then, there's also rent credits and whatnot. Um, you know, one of the things that I always want to do is look at the property as it is in reality before that exists. And then to see, okay, is this a sustainable property to invest in? And then if I think it is, then I can start to take into account the extra benefits I'm getting from these sort of tweaks that they're doing with the way the money is split up. The reason I think that's so important is because somebody has to pay that mortgage at the end of the day. If for some reason the co-owner doesn't, that responsibility will fall on the property itself, on the entity that owns the property. And so, I always want to be able to look at, like, how does this perform with the existing debt? And so I've been just doing that on my own, and I've been really hesitant to share my own model, on online, just because I'm very much not trying to just give you like financial advice, like this is what I'm doing and you should need to buy this or buy that. I want you to do your own due diligence. So I don't want to give you a tool that I built and be like, hey, use this, but no, it's still not advice, because I think when I get that far, that's, I don't know, then I think that's not super defensible. Um, you know, but I think that using a third party tool like this, and there are others that exist, but I really like this one that they built. And you have to pay a lot of attention to what the different assumptions are. I mean, this one, it puts some, pretty strong rental income growth figures in there. It put some, it just automatically did that. I didn't do that. It put some, it had the property taxes. It did not give us anything. It just goes into their base management fee. Now, currently with the co-owner, it's a zero. I think in a situation where he wasn't paying the mortgage, he's also probably not managing it for free. And so again, I just want to put some normalizing assumptions in here. I actually think 12% super low for a short-term rental. I know that's what the Mogul guys have negotiated with some of their providers. I might, if I'm really just looking at other properties elsewhere, I might bump that up to 15 or 20%, a lot of the time. Um, I did the purchase price, all of this stuff, you can adjust however you want. I think that um, probably could have just taken it out entirely, or just put the fees that you're paying to Lofty. I wasn't really sure what to do here, but I think this is a neat tool that we can start to use to look at properties on other platforms. And if you're using the same tool everywhere, I was surprised at how much it auto-populated. I thought that I'd have to go in and put everything else in. But so if I'm using it, across all the different platforms when I'm looking at properties, I can start to really realize, like, um, where some are maybe just making ridiculous assumptions. Like one of them is that Mogul is starting to price in a refi on every deal at a certain point, right? And I don't think that would make a ton of sense on this one, because there's this low interest rate, although it is amortizing. I did 26 years because it looks like that's about what is left on there. Um, but you can see, okay, this is a 4-year break even. It's not amazing. I had to add in the homeowners insurance. I'm sure, like, if I were going to spend a lot of time, I mean, I think you can tell from my two other videos that this is one that I'm not interested in. I think that even if it got extremely cheap, it's very difficult to. It would have to be a significant discount, because this would, for me, would be an equity play, not not a return, not a yield play, because I don't believe this is going to last for any significant period of time. Again, just because that's what I think doesn't mean it's what you should think, right? You should do your own due diligence, both on the platforms, and on the properties themselves. And with that being said, you do really want to play with this. You really want to understand, because there's a lot baked into this, right? Like, um, where the growth rates, you want to understand where those are coming from. You want to tweak them if they're different than what you would assume, right? One of the things, they're always using this 3% disposition Broker fee, I don't know what they're doing there. I mean, I think that most of the time we're going to pay a higher amount. Um, I feel like I asked them and they addressed it once, but if I'm looking at these properties separately from Mogul owning it, I want to have a higher number in there. But just with everything, I left most of their assumptions and I tweaked a few things. And this shows up as a negative cash on cash, but with a decent, not decent, but with a at least a positive, annual internal rate of return, because they're assuming that it's going to appreciate with a sale in the future. This, these having a negative number here makes perfect sense to me because if you look at the NOI and you look at the debt that the co-owner's paying, it's not covering the debt currently. It actually seems like this number should be a little smaller, um, in my mind, but I don't know. I mean, a little bit like a higher negative. Um, but it's certainly, um, it's a good, if you started to use this tool across every property that you looked on every platform, you'd start, I think it's just a good example of why when I'm looking at their properties, I'm like, oh, their average deal is just typically, especially from a yield perspective, doing so much better on an actual property to property comparison. Now, obviously, initially, the way that this one is set up, um, you're getting a higher yield. But I think that that could last as little as 3 or 4 months. And then, and then it gets brought down to the actual performance of the property, but with still the benefit of the way the leverage is treated. And so it is still, higher. You don't have that negative because the debt's being paid outside of it. But at a certain point, but one of the things in that scenario that you do lose is where most of this IRR comes from is the levered appreciation. And you don't really get the levered appreciation, that's really accruing to the co-owner in that situation. So I don't want to beat to death the fact that I think that this is not a great deal. At this point have seen my opinion on it. Somebody did comment on that video and share why they might invest in it, and I think it's a perfectly legitimate reason, especially when he mentions it's just a small number of tokens. Um, for me, I'm just really a numbers guy, like just always trying to maximize return and uh and sometimes to my detriment. I mean, I think that there are times where you can get too caught up in crunching numbers and sort of miss deals that it's like, oh, obviously that was a good deal. It, because of what the property was, it really outperformed, from an appreciation standpoint or something like that. I want to always be able to prove all my numbers, and so um sometimes I will miss stuff that, like, sort of a gut feel investor will be like, no, I just look at that, it's an oceanfront property. I want a piece of that view. I think I can't do too bad in the long run, buying that, and I am getting some return in the short run on it. So I think it's a defensible position. It's just not my position. And again, I mean, that's why, like, when, I'm trying to share the way I look at these things, it doesn't mean it's how you have to, right? I really enjoy all of the different discussions that have come out of this channel. So please do keep making comments. People join the Discord and talk about it there, talk about it in the comments. I have had some people talk to me through Twitter from this too. So anywhere you want, I'm happy to talk about real estate investing because it's just sort of the only thing I'm into, other than a couple of, play poker too. But other than that, this is all I do, both in my day job and all my free time digging into the fractional stuff. But in any case, this is really all I want to share is like that how useful this tool can be and how much you can use it to just. I think that it's really hard to make apple to apple comparisons across properties, across a lot of the platforms, and I think that I think it's useful to do that initially, and then you also have to look at, okay, well, what are the fees each one charges, and how do they actually allocate the cash flow, and then what am I, what's the net I'm getting out of it? But I think what doing just a true straight up real estate investor style analysis on the property itself, will give you a good idea if in the long run that property is going to be able to maintain the yield that it initially paid out. I think that if you look at a lot of the deals in the marketplace, and let me just move that over. You know, sorry, I was just having some technical difficulties again. But all I was really saying is, I think if you look at a lot of the deals that have gone poorly in the marketplace, that are down to in the teens or $20 range, most of those, I think the people that bought them at $50 did very little of their own due diligence into the markets, into, assumptions about the cash flow, about vacancy rates, any of that stuff. I mean, a lot of these properties, um, I think that if you were doing a more independent analysis of them, you're probably a lot of people wouldn't have paid what they paid for these. Now, I don't think you can just grab this address, throw it into the Mogul tool, and like instantly it's going to, give you all the right answers. I think you need to actually adjust a lot of the you have to adjust the vacancy rate or the vacancy reserve if it's a market that has really high vacancy. And same thing with maintenance if you've got some of these markets with higher turnover expenses. There's all sorts of things that you'll have to tweak, right? But I think starting with, I think this is a useful tool if you don't have one that you're already using. And it's one that presents things, very similar to the way I think about it. It is, but it's not like, you're not too in the weeds on a lot of stuff. So I think, that's all I wanted to mention. I think that if all of your due diligence is just looking at whatever site you're on, seeing what numbers they tell you, and buying from there, I think that is really just going to get you in trouble in the long run. Understanding, how's that property itself work? Does it spit out enough cash flow? For me, I think that's the bare minimum that I want. I want to see that before I'm going to even think about, okay, what's my return going to look like, right? Like rule number one, don't lose money, right? Like, so I want to make sure that whatever return it says I'm going to get, that the property can actually sustain itself first, and then sustain that return second. Um, I'm just not in my real estate investing business. I'm not in the business of just taking someone's word for it, right? I want to do all my own due diligence, and I think you should too. I want to run my own numbers. I know there's other calculators online that you might be able to use. This is just one that it happens to already be attached to a fractional real estate investing site, so you can, it's a good way to sort of normalize across a few different, across different platforms. If you're already investing on this one, you can look at other deals through this lens. I just thought that'd be super helpful. But it's certainly, it's if you have something that you're already using, I think that's great. If there's other online tools that you use to underwrite these deals, please let me know. Share that info in the comments or in the Discord. I think that there's a lot of different ways people look at deals. Uh, you know, at this point in time, I think I'm pretty old school that I put together Excel files most of the time. Um, and so which is why, who knows? I mean, maybe the kids today, they know that there's like 50 different websites that you can do this just as easily. There are things about this that I would change if I were doing it myself, but I think it's a great start, and I love that you can tweak things, and it tells you, because I just don't always take other people's assumptions at face value, and if I can change these things, to try to make a forward-looking guess about what I'm going to get paid or how the property is going to perform. That's why I like it, right? It's one of the reasons that I like this platform, but more so, um, I think they put this together because they really understand looking at deals. Anyway, that's all I want to share with you today. Until next time, just keep making mistakes like the one that led to this video. So if you catch one, let me know so I can correct it or learn from it. But yeah, until next time, going to keep making mistakes so that you don't have to.